Next up, we have Reservoir Media joining us for the first time. Reservoir is an independent music company based in New York City. It's the first female-founded and led publicly traded independent music company in the U.S. Founded in 2007 as a family-owned music publisher, it has since grown into a global platform representing over 150,000 copyrights and 36 master recordings, spanning works from the early 1900s to today's top hits. The company has about 65 million shares. It closed at around 735 yesterday for a 480 million equity market cap, 367 million of net debt for about 850 million total enterprise value. We have Reservoir's founder and CEO, Golnar Khosrowshahi here, and CFO, Jim Heindlmeyer, with us today. Thanks so much for joining us. We can take a seat and jump into questions. Great. Thank you so much for being here.
Thanks for having us.
So, starting high levels for those who are less familiar with Reservoir or the music industry more broadly, can you walk us through how the company has evolved since inception? And Golnar and Jim, could you share a bit about your backgrounds as well?
Sure. Well, first of all, thank you for having us. Nice to see you. We established the company in 2007, and we've been at it since. We've deployed probably just over $1 billion in capital since then. We didn't reinvent the wheel here. Our intent was to become a rights manager with an active platform, provide creative services, expand the business across publishing and recorded assets, which I'll get into. That's what we've done. I think that's a little bit of a theme in that we do exactly what we say we're going to do. My background before that was in experiential marketing and design, and also pretty heavy on the sell side or buy side music licensing. So I knew a lot about that world and just enhancing value of music assets. I'm a classically trained pianist, and so this has always been, music's always been a part of my life, and I'm lucky to be able to do what I love.
With respect to my background, I started my career at KPMG, and when I left there, I went to work at the time, the largest self-distributed indie label called TVT Records here in New York. And really have been in the music industry for almost 30 years now. After leaving TVT, was involved in a couple of different digital music service startups before ultimately finding my way to Reservoir and being here for the past 6 years or so.
Great. Thanks. That's really helpful. And then just shifting to the industry landscape and an overview. I mean, you guys have a great presentation covering the music industry, tailwinds, breakdown of publishing and recorded music that you share. It's still a great resource that I go to and look at for a refresher every now and again. Could you give us the quick 2-minute version just to help set the stage?
Sure. I think it's a very simple idea. There are just more people listening to more music in more places. And we've been saying that for a long time, and I would add to that today that they're going to pay more for music. So you have a market that is now estimated to be about 100 billion in size that is estimated to double in size by 2035. That very same market has the growth in those subscriptions coming from the emerging markets. The emerging markets will account for 68% of the growth that is to come, that will bridge that $100 billion gap. So those are the drivers. People are getting more connected. You are talking about 3 billion people coming online in the course of the next 5 years, and they are getting access to music platforms that they didn't have access to before, which makes them listen to more music. We love that, but we are looking at a fractured marketplace in the sense that we are paying $11, $12, $13, depending on what service you have, and in an emerging market, you could be paying $2. We do think that at some point, that gap is also going to get narrowed, in that the prices will increase in those territories. I think there are other sort of smaller drivers around Wi-Fi-enabled cars, for example. But again, it comes back to that original thesis that you just have access to more music more frequently, and that justifies the listenership hours going up.
That's helpful. And then the company was founded as a publisher, and you've since expanded into recorded music. Can you just talk about your split between those two segments and what you anticipate that looking like in the future?
Sure. So the publishing business is really the reliable portion of the music industry. These cash flows behave very, very predictably. We're extraordinarily good at predicting how they are going to behave, and that comes into play in our underwriting. If you look at publishing versus recorded, publishing is owning a copyright, owning the notes, owning the words. So we own the copyright for Take Me Home Country Roads, but that means that we are monetizing and getting paid not only on the John Denver version, but on the 400, 500, 600 other covers that are on Spotify. Those are all getting monetized in our favor. On the recorded side of the business, that's when we own master recordings. We don't own Take Me Home Country Roads, but if we did, we would only be getting paid on the John Denver version. If you look at just revenue split in our business, we're looking at about 30% of our business coming from recorded and 70% coming from publishing. It's very much our bread and butter. We have to be opportunistic about deal flow, so we can't really predict how that will shift, but there's no business plan that says that we have to be 50-50. There used to be quite a disparity between the value of these assets and how you would pay for them, what kinds of multiples you would pay for them, and today that is at parity. So it's not even that you can get better, you can be more opportunistic, let's say, on the recorded side, which used to be the case. So that's what the landscape looks like now. That could change, that could go up a little, down a little, but there's not really a business plan that mandates what that has to be.
Thanks, that's helpful. So talking about the streaming side of the business, are you seeing any impact from the broader macro environment or recent consumer spending pressures on music subscriptions? And then I guess how has the industry historically performed in more recessionary periods?
So we used to have a slide which we took out because I think it'll get us in trouble, which actually tracked recession and showed the size of the global music industry. And what that has revealed is that these assets are relatively resistant to recessionary times. As far as just consumer data goes and what impact that would have on consumer adoption or maintenance of streaming platforms, the thing about music is that, first of all, it's a very small portion of a budget. Again, as I said, you could be paying $10, $11, $12, depending on what service you have. Second, there is absolutely no product difference. The only product differentiator is the UX, which means that everybody in the world is disseminating the same content at the same time. I don't need multiple platforms. I don't need Hulu and Paramount and Netflix, all of the platforms. I just need one. And we are hard-pressed to see a situation where people are going to give up their music subscriptions as a result of macroeconomic factors or contraction. So that's our view on that. Hopefully we're right.
Yeah, that's helpful. Digital now accounts for the majority of both publishing and recorded music revenue. Where do you see the most upside in streaming growth from here, and what are the primary drivers? You touched on it a little bit, but I guess just driving down a little bit in terms of emerging and domestic markets and then pricing versus subscriptions.
So domestic, Western Europe, those markets are very much thought of as being mature. The emerging markets are definitely accounting for the growth coming from subscriptions. As I said, there's significant price difference, but the number is 68%, and that's fresh from the Goldman Sachs report that came out a couple days ago. That 68% of that growth is coming from the emerging markets.
That's helpful. How are you approaching newer non-traditional streaming categories like social, digital fitness, gaming, and the metaverse? What are kind of the primary buckets of these emerging areas that you see today? And what are you most excited about?
So this has very much been a theme in our business, in that there's constantly been a new platform, a new DSP come to market. We've either licensed that platform or we've gone into litigation and then ended up with a license for that platform. Really, I mean, if you talk about Spotify, YouTube, all of the platforms have sort of followed this progression. Peloton was the same thing. That opened up an entire category of in-home fitness products. So that's generally what happens. Right now, I think front and center is the debate on whether generative AI music platforms should be getting licenses in place and having those licenses in place in order for us to monetize how those models are trained. We'll see what happens there, but we just see new DSPs coming to market, new opportunities in gaming, whether that's, what was Roblox, what is the next Roblox, what is the next TikTok. So we see that developing, and we have a very, very strong track record as an industry for licensing that IP, and hopefully that's not going to be under threat anytime soon.
Agreed, that's helpful. Sync was a standout contributor in fiscal 2025. The fiscal year ends in March, with major placements like the Super Bowl and Beetlejuice. How scalable is this part of the business, and what infrastructure enables your success in this channel?
So this is the only free market part of our business. This is the only part of our business where we set the price, that it's not set by royalty rates that are set by the government. And so there is no cap, which is great. But realistically, could we have 50% of the income coming from Sync? I don't think so. We do have a team of 14 or 15 people now globally who are just dedicated to pitching and collecting on Sync. They are looking after, just on a song to service ratio, a really manageable group of songs, and we've been very focused on that part of our business because we're very focused on the spread between organic growth and what we do from industry growth and our organic growth number, which is what we do on value enhancement. The greatest contributor to that is Sync, and there's huge opportunity there. You obviously have to have high-quality music in order to make that happen, which I feel we do. And so we feel that given the contribution that part of the business can make to organic growth, it's very important for us to invest in it.
That's helpful. You mentioned how important it is to have that music in the catalog to be able to go out and kind of get those deals done. When signing talent or acquiring catalogs, are you often competing directly with the majors? I guess what draws an artist or songwriter to Reservoir versus some of the other peers out there? And are you seeing any shifts in leverage across the ecosystem?
So we are competing with the majors, probably more so on that part of our business than any other part of our business. And the most recent examples of that are Snoop, who was with Sony before he came to us. Katie Lang was with Warner before she came to us. Joni Mitchell was with Sony. The Isley Brothers were with Sony. He's not going to be very happy with us. So it's, I think the attraction is that they know the quality of creative service that they are going to get. They're no longer part of a major system. If you can believe, Joni Mitchell's contract had expired. She was free to walk. There wasn't even a negotiation there. So clearly that is talent that's not getting the attention that they need. So that is the big attraction. That they're going to be somewhere smaller, that they're going to have service that will ultimately build their value, their catalog value, but also put them in a creative situation that they want to embrace.
That makes sense. You've made major moves in the Middle East and India. How do the monetization dynamics in those markets specifically compare to the developed markets? I know you touched on this high level, but also how important is the first mover advantage in scaling in those regions?
We're still in the show me the money phase, so we hope that happens. It's a being on the ground, knowing the community, knowing the artists is extraordinarily important. They're probably more important than anywhere else to have those relationships. It's not a region, not India, not North Africa, not the Middle East, where you can do business by proxy. And so we've been on the ground there for 5 years now. We've set up the first rights management entity in the Emirates. We announced the expansion into India a few weeks ago and now have a local artist we've signed there, as well as others that we had signed before. And it's the monetization systems there have some catching up to do insofar as actually monetizing performance royalties. The subscription growth is yet to come. The subscription pricing is yet to mature. But a lot of these things are just going to be a switch that turns on versus a linear progression. Owning content in advance of what we believe will be sort of an explosive growth period over there as far as the monetization goes is just going to put us in an excellent position, especially because globally, it's not Taylor Swift being consumed. Globally, people are consuming their local music, their local culture, and being on the ground with that is very important.
How do you identify these more emerging regions that you want to take a big presence in? I guess just a little bit more on the thought process there.
It's really about the people and the team that we can partner with because we are thousands of miles away and we need to ensure that the business is run with the same rigor that we are running it over here, and so we need to have confidence in those leaders. The leader in the Middle East we have known for many, many years. He was actually a part of our team here, yet he has also lived over there for several years. So it was about the team versus is that market big enough? If we were going to go by what is the biggest market and where should we be in the emerging markets, we should have gone into Latin America. We didn't find the right team. We haven't found the right team yet. And until we do, we're hard pressed to go in, as I said before, to do business by proxy because I just don't think that's going to be successful.
That's helpful. And then Reservoir has grown over the years, both organically and also on the inorganic side. Can you talk a little bit about how you're prioritizing capital deployment across M&A, leverage reduction, any other priorities, as well as kind of what you anticipate doing in M&A moving forward, any areas of focus, genres, businesses, lines, that sort of thing?
Yeah, I'd say on the M&A side, I mean, we've been a very acquisitive company throughout our history, and that's not going to change. We generate a lot of free cash flow. We'll generate over $50 million in free cash in the coming fiscal year, and our priority is generally to continue to grow. So we will look to redeploy that money, tap our revolver to the extent that we have opportunities in front of us that are attractive. We have a goal, sitting there at a little over 5 times levered as a public company is fairly high, but our assets really lend themselves to leverage. When people understand our business, they're typically comfortable with where we are from a leverage standpoint. Having said that, we do have a goal over the coming years to kind of feather that leverage down. We don't need to do anything dramatic to bring it down. We're comfortable where we are, but we recognize that it's high as a public company, so we do have a longer-term goal to bring that down a bit.
That's helpful. And you've guided to 164 to 169 million in revenue and 68 to 72 million in adjusted EBITDA for your fiscal 2026. How should we think about the contribution from organic versus acquired business growth?
Yeah, it always gets a little bit muddy in our business when you try and identify organic versus growth through acquisition. When you're looking at year over year. For example, this past year we had a big hit with Espresso, Sabrina Carpenter's song. we don't project for another hit at that level. Having said that, we have typically had success year after year with number one songs, and we do look forward to continuing that. But we're not going to guide to that level of unknown hits at this point. There's also a little bit of noise in our business with a very small part of our business, which is the artist management business, which generated about $7 million in revenue in fiscal 25. The reality is we have a couple of artists who generate most of that money between Phoebe Bridgers, Cigarettes After Sex. With both of those acts going into kind of the normal cycle of an off year, we might have that revenue contract by $3 million in the next year. That's going to impact our organic growth. It's not something that you really think about. It's not indicative of lower organic growth on the core part of our business, which is the publishing and recorded side, but it's impactful. So there's a lot of noise in the weeds when you get into it. Having said all of that, like I said, we typically project our free cash flow going to continued M&A and advances to active songwriters, and we will factor that into our guidance accordingly.
That's helpful. We've talked a bit in the past about Reservoir being able to look at off-market deals and that contributing to your ability to do a lot of these acquisitions at reasonable multiples. Can you just touch on that a bit and how you evaluate return profiles between off-market and marketed deals? I guess the competition for high-quality assets, if that's shifting at all, and if you're still seeing strong private equity activity in the space.
We're still seeing a lot of capital in the space. We're still seeing people able to fundraise and execute on various structures. So there continues to be a lot of competition. I don't think that we really distinguish between the return profile of an off-market deal versus one that's going through a process. It has to be a good investment for us. It has to be accretive to the portfolio. The fact that we were able to get something off market is just a bonus. That's been thematic in our track record, and I think that's very much relationship driven. We're in exclusivity on a transaction now that we began cultivating in November of 23. So that just gives you an idea of how long that takes. As far as the assessment of the investment, we are first and foremost looking at an attractive return, a reasonable purchase multiple, which I believe in our latest disclosure is around 13 times, well below what is the market norm, and something that is going to maintain its value, have the terminal value, because that is very much a part of our underwriting, and have an accretive impact on the portfolio. When we look at the recorded side and on the publishing side, we also have to look at what kind of impact these transactions have on our infrastructure. We have transactions, types of royalties that we can acquire that have absolutely no impact and no costs associated with them, whereas others where we have to completely, not revamp, but add things, add resources. I think that we are well positioned today to continue to ingest assets across both types of music without having any impact on our overhead.
And I know you've touched on it a little bit, but anything specific you're targeting in terms of genres, geographies, or catalog profiles at this point, or just mostly what comes across the table and opportunities?
I think we're not big enough in the sense that we can't really close off a particular genre or decade or type of music. We're not big enough yet. The portfolio isn't such that we have duplicative assets in there. So it is really about being opportunistic. We had a run there where earlier this year and late last year where we were really just closing, not maybe by dollar mostly, but just the volume of recorded assets, recorded acquisitions. But we have to be opportunistic, and we can't really we can't really restrict ourselves to only buying assets in North America. We might have a time period where we're heavy in Europe. So that's just how we have to go.
That makes sense. I'll pause to see if there's any audience questions at this point. Yes.
Hi. First of all, thank you for very thoughtful. Microphone. Oh, sorry about that. Can you hear me now?
We could hear you before.
Hi, Jeff Sklar. Thank you for a very thoughtful presentation. When you think about expanding your reach, your impact, how do you think about disruptive technology, AR data? And I would even say thinking about your business, specifically like the evolution of streaming of spatial content, going from streaming to much more immersive streaming, does that represent a pathway for you, for more business or opportunity? And how do you think about that?
We have always been, in the course of the past 17, 18 years, extremely entrepreneurial around how we use technology. We were the first independent music company to actually strike a deal with YouTube and begin monetizing that platform. Our first check was $5,000. Today, we're over 10% of our income is coming from Google and YouTube. So it's very much in our history. We are using all kinds of platforms today that actually go and find the metadata and digital footprint of our music, and we're able to monetize those usages that we wouldn't have found before, that a human wouldn't be able to find, and monetize those and create this additional value on the assets that we've acquired. I think that there are all kinds of new executions that will be using music, whether they are immersive. It doesn't, I think it's, there's just, music is a part of our lives. It's a part of our existence. And the listenership hours, the numbers around that we have are because people are going to immersive experiences, are because of places like the Sphere, are because everywhere you go, you're listening to music. Owning copyright and owning intellectual property and having high quality content puts us in a position to consistently be able to monetize that regardless of what the usage is.
The more I listen to you, your capabilities on a global basis, and then look at the PE firms that are coming in, why not be the GP of an LP and have somebody like XYZ go out and raise a couple of $2 billion for you and use that as your currency?
We did try to raise a fund.
I know. The world changes all the time, though.
Well, we're running a very lean team, so today we're focused on running the business, and maybe if Jim will tell me that, tomorrow we're going to go out and fundraise and raise a fund, maybe that's what we'll do. But we are very much focused on scaling the business today. Not that that's not how we could do it.
And then I guess last one from me, just before we wrap, what are you most looking forward to or most excited about in fiscal 2026 from where we sit today?
I think we're going to see some significant changes and monetization events in the Middle East, in North Africa. I am particularly excited, and then that's really at an industry level. At a company level, I'm excited for a global roster putting out global music. And as I said earlier, we're talking about a product and an audience that is truly global. And then I think finally we're all excited to continue to deploy capital, to continue to grow the business and get out of this the size that we are now.
Great. Well, thank you so much. I think we're just about at time, so we really appreciate it, and we hope we'll have you back next year.
Thank you.
Chris Morangi is a co-CIO, and Sergey Glazevsky, Hannah Howard, and Justin McAuliffe are portfolio managers Gabelli Funds. This podcast is an excerpt from Gabelli Fund's 17th Annual Media and Entertainment Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of March 31, 2025, affiliates of Gamco Investors Incorporated beneficially own on behalf of their investment advisory clients or otherwise approximately 31.43% of Atlanta Braves Class A, 6.32% of Class C, 11.32% of Sinclair, 5.41% of EW Scripps, 2.67% of Gray Media Class A and less than 1% of Common, 2.41% of Tegna, 2.25% of Ryman Hospitality, and less than 1% of all other companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other Gamco officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at Gamco and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain Gamco personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI 800-422-355-4914, 921-5100 fax, 914-921-5118 info@gabelli.com.